Let's start by clearing away the misunderstanding that always appears the moment the word conspiracy is used. There was no secret meeting. No hidden committee. No late-night call where government officials, bankers, and developers agreed to quietly redesign human life around permanent debt. Nothing that theatrical ever happened, and that's precisely why what follows is so uncomfortable. Because despite the absence of any grand plan, we somehow arrived at a situation where 50-year mortgages are now being seriously discussed, not mocked, not dismissed, but defended as innovative solutions to a housing crisis that has quietly stopped being solvable within normal political boundaries. That outcome didn't require coordination. It required alignment. Each major participant in the housing system faced incentives that all pointed in the same direction. No communication necessary. No agreement required. Just rational actions taken independently, producing an outcome indistinguishable from collusion. That is what a real conspiracy looks like in modern systems. To understand how we got here, we have to rewind to the moment housing prices crossed an invisible political threshold, the point where letting them fall became unthinkable. After the pandemic, home prices surged at a speed that had nothing to do with wages, productivity, or long-term affordability. Cheap money, supply constraints, speculative demand, and policy distortion stacked neatly on top of one another. When interest rates later rose sharply, basic economic theory suggested prices should correct. They didn't. Instead, something much stranger happened. Transactions collapsed. Listings vanished. Volume dried up. But prices barely moved. Not because the market was healthy, but because it was frozen. Homeowners, locked into historically low mortgage rates, refused to sell. Developers, constrained by financing models built around high valuations, couldn't cut prices without breaking the capital structure underneath their projects. Banks were holding vast amounts of mortgage-backed assets that assumed price stability. Local governments relied on inflated assessments to sustain budgets and debt obligations. Everyone was trapped. And when everyone is trapped, the system doesn't seek truth, it seeks the least destabilizing illusion. That illusion quickly became obvious. Prices don't need to fall if buyers can somehow keep paying. This is where the housing crisis quietly changed shape. The conversation stopped being about prices and started being about payments. This shift is subtle, but it's the most important moment in the entire story. When policymakers talk about affordability, they rarely mean, can someone actually afford this home over their lifetime? They mean something far narrower and safer to work with. Can the buyer survive the monthly payment right now? That definition is politically convenient because it avoids forcing anyone to admit that prices are too high. If the payment can be engineered to fit into a spreadsheet, the system can declare success even if the total cost explodes. Finance loves this move because it's deceptively effective in the short term. And it's already been used everywhere else. Car loans quietly stretched from 4 years to 6, then 7, then 8. Tuition skyrocketed, but student loans allowed the bill to be deferred into the future. Buy now pay later turned consumption into an ongoing obligation. Each time, the promise was the same: don't think about the full cost, just think about whether you can keep going. Housing simply absorbed the same logic, only more slowly, because housing is heavier, more emotional, and politically sensitive. Once the question became, can the payment be lowered, instead of, why is the price this high, the path toward ultralong mortgages almost designed itself. A 50-year mortgage sounds extreme only if you think in terms of ownership. If you think in terms of cash flow management, it feels like a natural next step. And that's why it keeps resurfacing. Because under payment-based thinking, there is no natural stopping point. Every affordability crisis can be solved by extending time. But here's where the conspiracy logic tightens. Extending mortgage terms does extremely little to improve affordability in real terms. The monthly payment reduction from 30 to 50 years is modest, often shockingly so. And once lenders adjust for increased risk, that benefit shrinks further. What does change dramatically is the lifetime cost. Interest compounds. Slowly at first. Then overwhelmingly. Over 5 decades, borrowers can end up paying sums that rival, or even exceed, the original purchase price of the home, purely in interest. This is the trade being offered, a little oxygen now, in exchange for decades of financial gravity later. And even that limited relief doesn't survive contact with the market for long. Every time buyer leverage increases, sellers capture it. Prices reset upward. Developers re-anchor expectations. Credit expansion without supply expansion has never once produced cheaper housing, it only reshuffles who pays, and for how long. So the system circles back to the same pressure point. Homes remain expensive. Payments creep back up. Except now buyers are weaker, more leveraged, and more exposed to long-term risk. This is not an accident. It's the inevitable result of trying to preserve prices while pretending to improve affordability. The trap becomes most visible when you slow down and look at amortization, something policy discussions conveniently glide past. On a standard 30-year mortgage, the first decade of payments is already dominated by interest. Principal reduction is slow. Equity builds reluctantly. That's manageable only because the timeline eventually shortens the burden. On a 50-year mortgage, that dynamic stretches almost absurdly. The point at which payments meaningfully reduce debt is pushed far into the future, a future most borrowers will never reach. People don't stay in their first home for half a century. They move. They refinance. They get divorced. They lose jobs. They care for parents. Life intervenes. Under a 50-year structure, someone can pay faithfully for 10 or 12 years, covering interest, taxes, insurance, maintenance, and still walk away with negligible equity once transaction costs are considered. At that point, homeownership becomes a semantic trick. You lived there. You paid. But you didn't meaningfully own. This is what makes the conspiracy unsettling. Not the proposal itself, but how perfectly it aligns with everyone's incentives except the borrower's long-term security. Banks extend interest streams. Developers avoid price cuts. Governments protect tax bases. Existing homeowners preserve asset values. No planning required. No coordination necessary. Each participant simply avoids the one outcome that threatens them, falling prices. The cost of that avoidance doesn't disappear. It is transferred to time, and to people who don't yet have political leverage. And because the harm is distributed slowly, quietly, and individually, it rarely registers as a crisis. It registers as stress, anxiety, deferred plans, narrower choices. In the next part, we'll widen the lens further into demographics, retirement, intergenerational risk, and why once debt becomes the substitute for reform, reversing course becomes exponentially harder. It's about showing how a system can drift into something far more dangerous, a permanent answer to a problem it refuses to fix. Up to this point, it's possible to interpret the 50-year mortgage as a technical mistake, a badly designed financial product, a miscalculation in risk modeling, or a short-sighted attempt to keep markets moving. That interpretation is comforting, because it suggests the system simply got a few variables wrong and will eventually correct itself. But that reading stops working once you widen the timeline. The reason this kind of proposal keeps resurfacing is not that anyone believes it creates real affordability. It's because it postpones the consequences of refusing to address the underlying problem, and postponement is the one thing modern political systems excel at. Housing affordability, in its most honest form, would require a set of changes that are locally painful, highly visible, and politically expensive. Zoning reform angers existing homeowners. Density threatens neighborhood veto power. Price corrections wipe out perceived wealth. Municipal budgets built around rising assessments wobble. None of these outcomes are abstract. They happen in specific places, to specific voters, on election timelines that elected officials can't ignore. Debt, by contrast, is largely invisible at the collective level. It doesn't show up in planning meetings. It doesn't need public hearings. It doesn't produce protests. The pain appears slowly, as individual households make private adjustments, smaller homes, later families, longer working lives, narrower definitions of stability. No single moment looks like failure. This is why extending debt feels safer than fixing prices. It externalizes the cost across time rather than space. Instead of confronting a group of angry voters at once, the system asks millions of people to quietly manage the consequences on their own. That trade-off doesn't require cynicism. It emerges naturally from incentives. But incentives don't stop operating once a policy is introduced. They compound. And this is where the 50-year mortgage stops being a niche curiosity and starts revealing something more systemic. When debt obligations grow longer, behavior changes. People become less mobile. They hesitate to change jobs. They delay geographic moves that could increase productivity. They are less willing to take risks that might destabilize their cash flow, even temporarily. A society with longer debt tails becomes more cautious, more rigid, and more fragile, not less. At the same time, wealth accumulation becomes increasingly uneven. Those who entered the housing market earlier benefit from asset inflation and shorter remaining debt horizons. Those who enter later are asked to take on more leverage for thinner equity returns. Over time, this creates a sharp divide between asset-secure incumbents and perpetually leveraged newcomers. The latter still exists, but the rungs are spaced farther apart and greased. This unequal distribution of risk is not accidental. It's built into how postponement works. When prices don't correct, the burden shifts onto future buyers. When debt stretches, vulnerability concentrates at the bottom of the ownership timeline. And demographics make this dynamic even harsher. The average first-time buyer today is far older than in previous generations. Many are already approaching middle age when they sign their first mortgage. A 50-year loan doesn't end in their working prime. It cuts straight through retirement, assuming not just continued payment capacity, but continued stability deep into old age. That assumption isn't realistic. It's procedural. Debt structures don't care about human life cycles. They don't adapt to health shocks, caregiving demands, or shifting labor markets. They simply require compliance. If income stops, risk materializes. This leads to an uncomfortable question: what happens when debt obligations outlast people? The legal system is clear on this point. Debt doesn't dissolve with age. It intersects with inheritance, medical expenditures, and end-of-life decisions. The longer the term, the more likely that housing debt becomes a multi-generation entanglement rather than a personal choice. This outcome isn't hypothetical. It's already visible in societies that normalized long-term leverage across education, healthcare, and housing. The shock isn't one dramatic collapse, but a steady erosion of autonomy as financial commitments crowd out options. At this point, it becomes impossible to avoid the historical comparison. The 30-year mortgage was not chosen arbitrarily. It roughly aligned with a working life. It reflected an understanding that risk should decline with age, not accumulate. That ownership should eventually stabilize, not remain conditional. Extending mortgages beyond that boundary quietly abandons those assumptions. It redefines ownership not as a status achieved, but as a condition continually maintained. As long as payments clear, you stay. When they don't, the system reasserts itself. This is not efficiency. It's a philosophical shift. The deeper reason the 50-year mortgage feels wrong is that it treats time as an infinite resource, when in fact it's the most limited one individuals have. Stretching time masks the fact that no parallel expansion exists in wages, resilience, or certainty. It assumes lives will remain flexible long after institutions have fixed their positions. And once this approach is accepted, it becomes difficult to confine it to housing alone. If shelter requires lifetime debt, it becomes easier to justify similar structures elsewhere. Education, healthcare, retirement. Each begins to resemble a service accessed through continuous payment rather than secured through collective investment. This is how temporary workarounds harden into permanent social design. The most telling aspect of this entire episode is that almost no one in power frames it as a moral choice. It's discussed as a technical adjustment, a niche option, a tool at the margins. But when repeated often enough, marginal tools redefine the center. The system didn't announce that housing would require lifelong debt. It simply stopped defending alternatives. This is why conspiracy fits better than lie. No one made an explicit promise and broke it. Instead, lines were quietly shifted. Expectations recalibrated downward. Futures redesigned without consent. No secret meetings were necessary, because consent was never the mechanism. Exposure was. As long as each individual household absorbs its share of strain privately, the system appears stable. And stability, in political terms, is often mistaken for success. But stability purchased through permanent strain is brittle. It accumulates tension below the surface. It narrows life choices in ways that don't show up in growth statistics. It pushes major decisions, family, mobility, risk, into defensive mode. The final cost of that shift isn't measured in default rates or quarterly indicators. It's measured in the quiet downgrade of what people expect from adulthood. In that sense, the most ironic element of the 50-year mortgage is that it's framed as flexibility. In reality, it represents a narrowing of acceptable futures. The underlying choice has already been made: preserve prices, stretch people. Until that choice is openly confronted, proposals like this will continue to surface, calmly, rationally, and without apology. Not as exceptions, but as templates. And when that happens, the question is no longer whether the system can sustain itself this way. It's whether anyone remembers that it wasn't supposed to.